Look at the 20% rebound from the bottoms and think maybe things are okay.
This week's pause in tariffs and the market rally that's followed has investors seeing green.
Things aren't as good as the market is making it out to be.
MarketBeat's Gabriel Ossorio Mazzilli is sharing a wider look at the economy.
When you zoom out and look at the macro, you see funds flowing into defensive areas like the consumer staples ETF.
And why a cautionary report from Goldman Sachs,
The market has the chance to go lower by 20%.
could still be very relevant today, despite the positive impact of the temporary tariff pause with China.
There might be some risk down the line for the S&P.
Could this be the turnaround we've been waiting for, or just another sign of more volatility ahead? Let's dive in. Gabriel, great to have you back on the channel today. We want to talk about all of the green and the positive signs we're seeing in the market today, but you are also going to give us an important warning, or at least some caution, from Goldman Sachs. We're going to get to that news in just a minute. If you're a regular subscriber here, you know we cover all sides of the stock market. And if you are not a subscriber yet, we would love to have you hit that subscribe button and make sure to join us for all of our stock market news coverage here. Gabriel, let's get to the big news of the day right now, and that's the continued positive momentum after Monday's announcement. The market's still doing pretty well.
That's right. The market is pretty excited about the new 90-day pause on tariffs between China and the United States. However, that excitement might be short-lived according to Goldman Sachs analysts. But before we get to that, we have to keep in mind that both Bitcoin, gold, and a bunch of other risk-on assets like Palantir, Coinbase, and a bunch of other stocks that don't necessarily follow the fundamentals, but rather the hype, have been rising on a pretty much straight line since yesterday, right? So it looks like the market is pricing in a more friendly environment when it comes to the economy, a more clear path when it comes to trade, new orders, production, and the income for the nation as well. So all of that being said, looks like everybody's buying into that news, and maybe Goldman is wrong, but from the way I see it, those factors that they point out, those fundamental themes that they pointed out in their report are still present despite the new 90-day tariff and a bit more certainty when it comes to the economy.
Yeah, we're going to dive into that report that you're talking about. It's a nice teaser for our viewers this morning of what is going on with this Goldman Sachs report, kind of expecting or warning of a potential downturn. And this news right now is really in contrast to what's happening in the market this week. So it's interesting to talk about this on a week when everything is so positive right now, and all of those indicators, like you said, are showing green right now. Everything's on the positive side of things. But it also kind of points to fear and reaction to the news versus fundamentals. And I think that's what this Goldman Sachs report is really focused on. So Gabriel, what does that report say? What is the warning from Goldman Sachs recently?
Right, so Goldman Sachs came out in early May 2025 saying that the market has the chance to go lower by 20%. Now this comes after the S&P 500 made its bottom around 4,900 during Liberation Day. Now, the market has recovered by about 20% from that low, technically making a bull market. But I think that the reasons that this Goldman Sachs analyst is calling for a drawdown are still present, despite all the momentum, despite all the excitement, and even despite the big news that just came out over the weekend, where the US and China have now landed on a 90-day pause for the tariff agreement. So whether they're right or not, I think that we have to look at the indications behind the report first.
Yeah, there's a lot of factors in this report that are good cautionary tales for investors to keep in mind. Even with all of the positive news that we're seeing right now, these factors are still present, and that does include tariffs. Let's talk about the impact of tariffs, even though this deal has been reached, at least temporary deal has been reached for now.
For that, I would start with the tariff impact itself. Okay, so even though we have a 90-day pause, these tariffs are still higher than they were last year, than they were 4 years ago. And that's still going to have an impact when it comes to the global economy. So even though the United States pulled back to 30% from the insanely high 145%, that is still higher, right, than where we were 6 months ago. And China has now lowered their tariffs to 10% for the United States. That's better than where it was 2 weeks ago, but it's still higher. So the economic impacts are still going to be felt when it comes to cost, when it comes to trade, maybe creating some bottlenecks, creating some a little bit of panic when it comes to people stocking up on inventory before these costs are put into place. The second part, and of course, the implication from these tariffs and the lower trade, lower activity, is underlying earnings. If you have a higher cost, margins are definitely going to go down, and volume as well. So when that happens, these Goldman Sachs analysts are calling for lower earnings per share across the S&P 500. And as you know, where earnings go, valuations go as well. So for that reason, I think that it doesn't matter if we have a 90-day pause, if we have a lower tariff rate. Nonetheless, these are higher, like I said, from a year ago, from 2 years ago, even a month ago. So that being said, I think that the thesis for lower earnings and therefore lower valuations still stand today. So, whether they're right on that or not, they might not be as dire as they were last week, but they are still present as a tail risk.
Yeah, that slowdown in earnings certainly has to impact the overall value of some of these companies. Is that also one of the concerns that Goldman Sachs is looking at?
Absolutely. And I think that it was interesting that they only focused on tech. They could have focused on a bunch of other stocks like industrials, manufacturing, even retail, because those are arguably the ones that will be affected the most from higher tariffs. However, they're not as expensive, they're not as high flying, and arguably they're even at a discount in today's market. So they focused on tech, and I'll tell you why. They quoted that the valuations in US tech are expensive right now compared to other countries like China, Brazil, and even Europe. And I would agree with them. I think that the forward PE multiples on stocks like Nvidia, Apple, Amazon are a bit overextended right now, even though most of the time you can justify these premiums because of the quality, size, and market share of these companies. However, there has been a divergence between forward PEs and price action, right? So as these stocks recovered during the bottoming and then bull market rally in the S&P 500, most of these magnificent seven tech stocks have fallen behind, not breaking out that 20% rebound from the bottoms and seeing their forward PE ratios fall behind as well. So now comes the argument, which I think is what they were trying to make in the report, that the market is discounting valuations for a reason. And usually, when the market doesn't want to pay up for future earnings, it means that these future earnings are not going to be growing as they used to. So when you connect the dots, it makes sense to see higher tariffs, lower economic activity, lower earnings, and therefore lower valuations, right? So that's what you see in the forward PE. And now you might think, well, tech has nothing to do with tariffs, but they actually do. Because if companies stop trading, companies stop doing the volume of products and new orders that they used to, they're going to be using less tech, less cloud computing, less AI, less chip making, and less equipment as well. So I think that you can connect the dots there. And like I said before, these aren't factors that are going to shift from one day to the next or 1 week to the next. So that factor might still be a present risk and even a tail risk in the S&P 500.
Yeah, it will be really telling to see what comes out in NVIDIA's earnings report coming up in a couple of weeks. But you are so right that the slowdown in these big tech companies has to happen at some point. They can't continue seeing that 5x, 10x growth that they've seen for the past few years. If you as an investor are looking for the next big company, check out this free report. It's 7 stocks that could be bigger than Nvidia, Tesla, and even Google. You can scan the QR code or click the link in the description of this video to get that free report just for our YouTube viewers right now on MarketBeat.com. All right, Gabriel, so we've talked about valuations being an issue and potentially earnings being lower for some of the biggest names out there. There's a few other indicators in this Goldman Sachs report that I think are really important for investors to know. And one of them, too, is that move to safety that's still there despite what's happening in the market right now on the positive side.
That's correct. I think that you can look at one single asset like the S&P 500 and look at the 20% rebound from the bottoms and think, maybe things are okay. Maybe the economy is going to make it out okay after all of this uncertainty and all of this battle back and forth between the US and China. But the reality is that when you zoom out and look at the macro, you see funds flowing into defensive areas like the consumer staples ETF, right? A multi-billion-dollar flow went into that ETF over the past quarter. That's not a behavior that is connected with a certain economy or a certain bullish outlook on overall stocks, right? More than that, you see the euro dollar performing over 10% on a year to date basis. Now, when it comes to currencies, you have to understand that the euro dollar is the most liquid, is the most available in the market. So when things get volatile, when things get uncertain, people look for liquidity, people look for safety. So that performance in itself, which is high for currencies, tells you something as well. And then there's the last aspect of this, which is bonds. People aren't buying bonds because there's also the uncertainty of the US debt, the US refinancing that's coming up soon, and the way that China and the US are, on that battle right now for tariffs, aren't really making bonds that are attractive now. So you could make the argument that people are getting out of bonds and into other safe assets like gold. Just look at the performance over the past 6 months of gold versus the S&P. Gold has been making higher highs and frankly new all-time highs historically, while the S&P struggles to get back to the 6,000, 6,200 mark as well. So you can see that in Bitcoin as well. Bitcoin has been going up, which is a risk asset, but has been leaving the S&P 500 behind. So look at the S&P 500 and get your view on the market. But you have to zoom out and look at everybody else. And everybody else is telling you that there might be some risk down the line for the S&P.
Yeah, even though we're seeing some positive indicators right now, it doesn't mean that risk is gone. And I also, it seems crazy to talk about this word in the middle of a really strong rebound in the market. Let's talk about what this Goldman Sachs report said about the possibility of recession.
Yeah, so this Goldman Sachs analyst is calling for a 45% probability of the US falling into recession. Now that is in line with what JP Morgan, Wells Fargo, and Citigroup analysts are saying as well. And it might not seem like it again when you look at only the S&P 500, which is now technically back in a bull market, and so is the Nasdaq. But here's the thing. When you look at other indicators like consumer spending, inflation, and even the PMI indexes, everything from the business sector to consumer is telling you that everything is slowing down. So there's a massive disconnect right now between where the S&P is pricing in future GDP growth and where GDP growth is actually going based on the hard data. Now, this call might be shifted probability-wise when it comes to the 90-day tariff pause. But like I said at the beginning, these tariffs are still higher than they were a year ago, 2 years ago, and even a week ago, right? So that has to have some economic impact that are going to show its fangs. It's going to show the white of their eyes when it comes to inflation, when it comes to trade, when it comes to economic activity. So you could look at housing, you could look at business, you could look at the consumer and realize that things aren't as good as the market is making it out to be. So I would stand by that probability, maybe make it even higher based on everything that you could see outside of the S&P 500 and into the US economy. And if I could say one thing, is that Warren Buffett is sitting on a record cash pile that hasn't been deployed even after that massive sell-off on Liberation Day. So if you want to bet against Warren Buffett and why he hasn't invested, I think that you're going to find out why Goldman Sachs is calling for a 20% sell-off.
Yeah, really interesting indicators to watch right now. I think I want to end this with talking about retail investors and just investors in general being so reactionary to whatever the mood of the moment is. The tariffs are announced and it's doomsday. The market is coming to an end. People are selling, moving to cash. As soon as the positive news comes out, it's a turnaround. Don't miss the turnaround. Everyone is just following the news and the headline of the day. And it seems very reactionary versus if you step back and take a pause and look at what those long-term investors like Warren Buffett, even what the institutions are doing right now, you can see a lot of the big players are still being very cautious. Talk about some of that institutional buying that's happening right now and what indicators that could give retail investors too.
Right. So when you zoom out, as you said, and when you keep a cool head and you don't suffer from the FOMO, right, the fear of missing out, or you are waiting for the big sell-off to get stocks at a discount, but then when the sell-off comes, you panic and you don't do anything. That is human nature. Like Warren Buffett said, you have to check those feelings at the door when you come in and analyze the market. So Warren Buffett is a great indicator of you have to do nothing right now. That's essentially his message. Because otherwise he would have been buying all the great companies at a discount when the Liberation Day sell-off came. Then you see the inflows into the defensive names and into gold as well. So if the economy is cleared of all this uncertainty and cleared from all the tariff implications, why wouldn't they be buying high-flying names like tech or retail or something that's a bit more cyclical, right? Why are they going into utilities, defensive names, and consumer staples? There's one reason for it. They're recession-proof. So if they're expecting a recession, you bet they're going to bet their money on these names as well to mitigate some of the effects, right? So I think that investors, retail, and professionals should step out, like you said, zoom out, and assess the whole situation. Do I really want to buy as stocks are going up, or do I want to keep a cash pile like Warren Buffett? Maybe not as big, but still some liquidity on the side. So by the time stocks come back down, I can really get in with a solid fundamental thesis. And again, risk is not really volatility. Risk is how much you pay for each asset. So if you overpay for any company, your risk profile is going to go through the roof. So again, if you're worried about the market, you're worried about the economy, the best thing you can do is wait for a better price. Wait for the best price in the companies you want to get into, because that's when your risk really, really compresses.
Some great information for investors to consider, Gabriel. Thank you so much for your time today. I want to hear what you think, viewers. Are you one who's still being very cautious, like a lot of these institutions and even Warren Buffett? Are you waiting for another big drop in the market? Or are you really believing this turnaround is going to stick and just move the market even higher the rest of the year? We'd love to hear your thoughts in the comments. Thanks so much for watching, everyone. And as always, happy investing.